When you throw a ball straight up into the air, there is a tiny window of time where it seems to defy gravity. Right before it drops, it reaches its peak and hangs there, completely frozen. The upward momentum has died, even though the ball hasn't actually started falling yet. The stock market follows this same law of physics. Most beginners lose money because they only look at the price. They see a stock climbing and decide to buy in, without realizing that the energy driving that climb has already vanished. To trade successfully, you need a way to look beneath the surface, like an X-ray tool for a chart. It allows you to see if a rising stock still has fuel in the tank, or if it's just coasting on a momentum that's about to run out. Spotting these moments doesn't require a degree in mathematics. It just requires a logical shift in how you observe the movement on your screen. There are two specific tools that help us see this. The first is the RSI, which measures the market's raw power. The second is a sequence of numbers called Fibonacci, which identifies the natural spots where a price is likely to stop and rest. If those names sound complex, think of them in a much simpler way. It's just like watching a car try to drive up a steep mountain. When you learn to combine these two tools, you can spot the warning signs of a reversal long before the rest of the market notices anything is wrong. In this analogy, the car's position on the mountain is the stock price, and the gauge at the bottom is the RSI. Think of the RSI as the car's speedometer. It isn't telling us where the car is, it's telling us how much power is actually coming from the engine. A common mistake is believing that if the needle goes above 70, the engine is overheated and the car must stop. But as you can see, a car with enough momentum can keep driving upward for a long time, even when the gauge is pinned at the top. A more reliable way to read this is the 60-40 rule. When the RSI stays above 60, the buyers have the pedal to the floor. When it's below 40, the sellers have taken over and are pushing the price down. Because a strong engine can stay at high power during a long climb, we don't use the speedometer by itself to guess where the mountain ends. We use it to watch for a specific kind of disagreement. That disagreement happens when the price of a stock and its actual momentum start moving in different directions. Imagine the car pushes to a new, higher point on the mountain. On the chart, this looks like a higher high, and to an average observer, it looks like the trend is stronger than ever. But when we look at the speedometer, we see a mismatch. While the car reached a new peak, the engine power actually dropped. The engine is working less than it did before, which tells us the car is about to slide backward. We can see the same thing when a stock is falling. The price might hit a new, lower valley, but if the RSI shows the engine is starting to rev up and climb, it's a sign that the downward slide is almost over and a bounce is coming. These mismatches show us when a price move is built on a hollow foundation. It's evidence that the current trend is coasting on fumes and a reversal is likely. Once we see that the engine is losing power, the next question is, where exactly will the car stop to refuel? To find that location, we look at natural percentages called Fibonacci levels. This method is named after an Italian mathematician who identified a specific numerical sequence that appears everywhere in the natural world. These proportions govern the massive spirals of distant galaxies, dictating exactly how they expand through space. And we find those same exact measurements at the smallest scales, like the internal chambers of a seashell. In the stock market, when a price starts to pull back, it tends to respect these same natural proportions. It often stops to rest at 23, 38, 50, or 61% of its previous move. Traders pay the most attention to the golden zone between the 50 and 61% marks. This area acts as a psychological pit stop where buyers and sellers often reach a new agreement. To turn this into a strategy, you first find a stock that is climbing. When it starts to dip, you measure the entire move from the bottom to the top using those Fibonacci levels. You wait for the price to fall into the 50 to 61% golden zone. But we don't buy just because the price hits a line. We check the speedometer. We want the RSI crossing back above 60, proving the engine strength is returning. By combining a natural resting point with a momentum check, you aren't just guessing on a direction. You are waiting for the math and the engine power to line up before you take the risk. The stock market can often look like a sea of noise and chaos, where prices move without any clear reason. You can navigate that chaos by looking for these specific signals. the strength of the momentum, the mismatches between price and power, and the natural resting zones. No strategy works every single time. There will be days when the news or market conditions break these rules. Risk management is always the most important part of the trade. The best way to start is to open a chart and look for these patterns in the past. Once you know how to see the engine power beneath the price, the charts on your screen will begin to tell a much clearer story.